everyone, welcome to our latest edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today we're going to talk about the spooky season that October has been for the stock market. And so coming into October, we were coming off of a quarter where the S&P was down 3.2%. And again, if you've been watching my other videos or reading my blogs, you know this was not unexpected. Markets have been running very hot, very deviated from their long-term moving averages. And so we expected to see some sort of a pullback in markets. We certainly saw that last quarter. And so where the indexes were grossly down kind of across the margins. But what I want to talk about kind of today is just kind of where we are year to date looking at the indexes, because I think a lot of people are going to be surprised to see how narrow leadership and returns across the market have been. And so if you can see here, these are year to date numbers coming into October 1st. S&P 500 up 11.68%. The Dow Jones was up only 1.09%. The NASDAQ was our leader so far year to date, up 26.3%. Commodities down 7%. The bond index, remember bonds are typically a safe haven, a place of stability, actually negative for the year, negative 1.21. And then mid caps are only up 2.61. Our small cap index up 1.35, and international up 4.49. So that's a pretty big margin. So in terms of returns, when you look at the S&P and the NASDAQ being really the only areas of notable performance returns. So a lot of the market is just very narrow right now. I'm going to show you another example in just a moment of that. But I think that most people are surprised that if you weren't invested in big tech, in large cap growth, your returns were probably fairly negligible year to date coming into this most recent quarter. And something else that's I think really important to talk about is just how concentrated those returns of the 26% and the 11% in the S&P and NASDAQ, how concentrated they are in 7 companies. And so if you look at the big 7, Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla, if you were to take all of those returns out year to date, the S&P 500 would only be up 4.55%. Everything else has been as a result of those 7 companies. So essentially, if you were not invested or exposed to those 7 companies in large cap growth funds, your returns were probably very muted year to date. And then this is just another way of kind of showing how concentrated the S&P 500. Only 26% of funds in the S&P 500 are actually beating the index. So that means that we have about 74% of funds in the S&P performing worse than what the index did. Not surprising when we know that most of the year-to-date returns has come from 7 companies. So if you take those 7 companies out, most of the other companies are dragging. So really though, what it shows us in terms of, we talk about market breadth, and so that is the market generally doing well? Is it positive? Is it healthy? And I would say right now we're really in a situation where it's very rare to see concentration like this. I mean, if you look back, we have to go all the way back to the 90s to see concentrations of these levels where the returns are so dependent upon just 7 companies. And so I think that's it's an important distinction to look at, because especially if you're comparing your returns to the S&P 500, 7 companies in the S&P 500 are responsible for most of those returns. And when you look again at the other indexes, their performance has been really less than exciting. So interesting. I'm very curious to kind of see what happens this quarter. Is this the quarter as we come into Q4 that we're going to see some normalcy return and these other indexes have some other more positive returns, kind of stronger footprint, or are we going to kind of see more of the same? And we're just going to have to see how that plays out. So coming into September, again, as we came into the summer, I was very concerned about how deviated the S&P 500 had gotten from our mid and long-term moving averages. And so there was quite a deviation. If you'll remember, I said one of 2 things is going to have to happen. pricing is going to have to come down, or these medians are going to have to rise, because they're going to have to reconcile. And so what we saw was back in August, we saw a reconciling finally happen, and that was of course relating to pricing finally coming down. We started in that corrective process, and so we ended the quarter being down 3.2%. But as you can see, our 50-day moving average did act as a nice line of support there, and so we kind of bounced off. Now this has continued to be resistant, so this is returns as of yesterday, and so we've seen the S&P really struggle to get now above our moving average here. So, and I misspoke. So this is our 200-day moving average. This is our 50-day moving average. And so that 50-day is really acting right now as an inversion that we're having trouble getting through. And so we're just going to have to see. We've been kind of bouncing off here, not able to do a whole lot. So sometimes we will just kind of trade in a pattern like this for a period of time. Now, interestingly enough, October is typically a weaker time for the market, and so it's just going to be interesting to kind of to see if that holds true. You know, we just coming off of a quarter where we had negative returns. Right now, markets are up about 1%, 1 to 2%, depending upon what you're looking for the month. So hasn't been such a bad month so far. We'll see. We're just about midway through here now. So I always like to remind clients when we meet with them the fact, though, that pullbacks and corrective processes are all part of normal healthy markets, and so we can expect to see a 5% decline every 4.5 times a year. They typically last about 24 days, and so we just went through this last 5% correction over the summer, and so we can expect to have a 10% decline every 8 months, a 15% decline every year and a half, and 20% decline every 2.5 years, of course, the most recently being back in 2022. And so these are all part of normal market processes, and I know that going through a quarter where we saw a lot of volatility kind of coming through, it can be a little discouraging. So I think it's important just to remember that. And I think that it's also important to remember that when we look back into history, when markets are positive for the first half of the year, that tends to bode very well for the second half of the year also being positive. And so we know that if the first half of the year is up over 10%, which it was, the second half is typically positive 82% of the time. And so a strong first half to the year has historically been a good sign for the market coming into the second part. And so, as you know, soon, it's hard to believe it, but money managers are already going to start kind of window dressing. Their funds are going to be purchasing additional equities to kind of get ready for the next year, leading us into the Santa Claus rally that we always look forward to seeing if that's going to come. And so, again, we're going to kind of start seeing some repositioning even in these areas of equities that maybe haven't performed so strongly so far year to date. So I think it's really important here, though. So when we see things like the NASDAQ being up 26%, the S&P 500 is up 11%. It's real important here, though, that we don't try to chase returns, because it can be really tempting to say, okay, so, international hasn't done great, mid-cap hasn't done great, small cap hasn't done great, value hasn't done great. I'm going to just dump all my money into the large cap growth because that seems like where, it's all going. And this is where it's really important that we remain disciplined. And this is where we make sure that we have a process that we're following, and that we're following our rules, because we don't want to go by emotions, and we certainly don't want to just kind of chase past performance. We want to kind of make sure that we have methods for why we're purchasing what we're purchasing, why we're holding what we're holding. And so, we have a set of rules that we follow. One of our biggest rules is that we let our winners run, we cut our losers quick. And so that's just kind of like a hallmark, is when we're looking at things, that's important. But, to not make knee-jerk decisions. And again, we just really want to make sure that, if you don't have an investment policy that you're following, that's really the first thing that you kind of want to come up with. Everything that you hold, we've talked about this many times, there should be purpose to it. There should be a reason and a method for why you have what you have in your portfolio, and you should sell it when it stops performing whatever that role that you have for it is. And so that is really just what I wanted to get into today. It's certainly been an interesting year so far as we've come through. Again, just seeing that narrow leadership where we've really only seen those large cap growth and tech names kind of emerge as leaders, and then very narrow even in those indexes into 7 companies. And so again, we're all just kind of watching and waiting to kind of see what the fourth quarter is going to show. If we're going to kind of see other leadership emerge, or if it's going to be more of the same, what's been happening year to date. And so again, just we're looking forward to meeting with you again next month. Questions, please, you can always reach out. You can give me a call. You can email me. We'd love to hear your feedback. And so otherwise, I hope you're doing well. Have a great October, and we'll see you next month.